Choppy markets are one of the most difficult environments for day traders. They look active, but price lacks follow-through. Moves start, stall, reverse, and repeat. This creates a series of small losses and psychological fatigue rather than clean opportunities. 1. False breakouts and breakdowns. In choppy conditions, price frequently pushes above resistance or below support, then immediately reverses. Breakout traders get trapped long at highs or short at lows. Instead of continuation, the move snaps back into the range, producing quick stop-outs. Here's what's actually happening. Why false breakouts occur. In a range, liquidity builds above resistance and below support. Many traders place buy stops above resistance, sell stops below support, breakout entries in the same areas. Price pushes into that liquidity, triggers those orders, then reverses because there's no real momentum behind the move. The breakout becomes a liquidity grab rather than a trend start. Typical false breakout structure: 1. Price approaches resistance after multiple touches. 2. Quick push above the level. 3. Volume does not expand meaningfully. 4. Follow-through candles are small or immediately reverse. 5. Price falls back into the range. This often creates what traders call a bull trap or bear trap. Common signs you're about to get trapped. Breakout candle has long wicks. Next candle fails to continue in same direction. Volume is average or declining. Level breaks by only a few cents. Weak extension. Market overall is also range-bound. Multiple failed attempts earlier in the session. The biggest red flag: breakout, immediate stall. Clean breakouts usually accelerate, not hesitate. Why this hurts day traders. Breakout strategies depend on momentum. When momentum is absent, entries occur at the worst price, top of move. Stops are triggered quickly. Losses happen before trade has time to work. Multiple attempts compound losses. This creates the classic death by 1,000 cuts scenario. Example scenario: stock ranges between 49.80 and 50.00. Price breaks 50 real. You go long at 50.05. It moves to 50.08, stalls, then drops to 49.80, stop hit. 5 minutes later, it breaks 50.0 again. Same result. This is textbook chop behavior. How traders reduce false breakout risk: wait for candle close above level, not just wick. Require volume expansion on breakout. Enter on pullback to the level, not the initial break. Use higher time frame confirmation. Avoid breakouts after multiple failed attempts. Skip breakouts during low volatility periods. A more conservative approach is break, hold, pullback, continuation. That sequence filters many traps. Choppy markets reward patience. The more urgent a breakout feels, the more cautious you should be. 2. Poor risk to reward setups. Ranges compress volatility. When the distance between support and resistance is small, potential profit shrinks while stop losses often remain similar. This compresses the reward side of the trade, making even correct entries statistically weaker. In a range, price repeatedly oscillates between nearby support and resistance. That limits how far a trade can realistically travel before hitting opposing pressure. Your profit target becomes constrained, while your stop loss cannot shrink proportionally without being hit by normal noise. How the math breaks down. Imagine a stock moving inside a tight $1.40 range. Support 99.80, resistance 120. You buy near support at 99.90. Logical target near resistance at 115, potential gain 25 cents. Logical stop below support at 99.70, risk 20. That's only about 1.2541 reward to risk. After slippage and commissions, it may be closer to 1.1 or worse. You now need a very high win rate just to break even. In contrast, trending markets often allow same 20 cents risk, 60, $1 per potential move. That produces 3.1 to 5.1 opportunities, which are much more forgiving. Why stops don't shrink in chop. Even though ranges are tight, volatility inside them is erratic. Candles overlap, wicks extend, and price probes both sides frequently. If you tighten your stop too much, normal fluctuations trigger exits. You get stopped before the move to the other side. You increase trade frequency and losses. So traders face a dilemma. Tight stop, frequent stop-outs; wider stop, worse reward to risk. Either way, expectancy suffers. The hidden cost, win rate illusion. Choppy markets can produce many small wins. Buy support, small profit; sell resistance, small profit. But one or two slightly larger losses can erase several wins. This creates a misleading sense of accuracy while profitability declines. Example: 4 wins at plus 5/5 equals plus and 60 cents. 2 losses at minus 35 minus 70 cents. Net minus 510 despite winning more trades. Additional factors that worsen RR and CHOP: slippage when price quickly reverses, spread widening in low momentum, partial fills near range edges, fake breakouts increasing loss size. How experienced traders adapt: they either reduce targets and risk proportionally and scalp very precisely, or avoid trading until range expansion occurs, or switch to mean reversion strategies with strict rules, or trade smaller size to limit damage. A practical guideline: if the realistic target is not at least 1.5 to 2 times your risk, the setup is usually not worth taking. In choppy markets, many trades fail that test. 3. Indicator noise. Most indicators perform poorly in sideways action. Moving averages constantly cross, creating whipsaws. Momentum oscillators flip between overbought, oversold rapidly. Trend indicators produce conflicting signals. You end up reacting to noise rather than real directional bias. Why indicators fail in CHOP. Most indicators are derived from price and assume some level of directional persistence. When price moves sideways, momentum repeatedly flips, trend calculations constantly reset, signals lag and contradict each other. The result is whipsaws, entries followed quickly by opposite signals. Moving average whipsaws. Moving averages work best in trends. In CHOP, price crosses above buy signal, then drops below sell signal, then crosses again, new buy signal. This can happen multiple times in minutes, generating losses from repeated entries. Shorter moving averages, like 9, 20, are especially vulnerable because they react quickly to noise. Oscillator overreaction. Indicators like RSI or stochastic depend on overbought, oversold extremes. In choppy markets, RSI hits overbought, you short; price barely moves down, then reverses. RSI hits oversold, you go long. This cycle repeats without meaningful follow-through. Oscillators become trapped between 30 and 70, producing low-quality signals. Trend indicators lag badly. Indicators such as MACD or trend-following systems often trigger late entries after minor moves, reverse quickly as price shifts direction, produce small gains followed by larger losses. The lag that helps in trends becomes harmful in sideways movement. Volume-based indicators distortions. Even volume indicators can mislead. Small bursts of volume appear like breakout interest, but lack continuation. OBV or accumulation indicators flatten and lose meaning. Without directional conviction, volume signals don't translate into trends. Signal clustering problem. In CHOP, multiple indicators often give signals simultaneously, but they're all based on the same noisy price movement. This creates false confidence. Moving average crossover. RSI oversold, MACD turning up. All align, but only for a brief bounce inside the range. How traders reduce indicator noise. Use fewer indicators, avoid stacking lagging tools, increase indicator periods to smooth noise, combine indicators with key support resistance levels, wait for volatility expansion before trusting signals, favor price action over indicator signals in ranges. A practical rule: if indicators are flipping direction every few candles, the market is likely choppy and signals are low quality. 4. Overtrading temptation. Choppy markets look busy. Traders feel they should be doing something. This often leads to taking marginal setups, forcing trades without confirmation, revenge trading after small losses. This increases commissions, slippage, and emotional errors. 5. Stop loss clustering. Ranges tend to hunt liquidity. Price repeatedly moves just far enough to trigger stops before reversing. Traders using tight stops are particularly vulnerable, resulting in multiple small losses in a short period. 6. Psychological damage. Choppy conditions create frustration because you may read direction correctly but still lose. Wins are small, losses accumulate, confidence drops quickly. This leads to hesitation when clean setups finally appear. 7. Time decay of opportunity. Trend days often produce sustained moves where one good entry can pay. Choppy days require precision. Missed entries rarely provide second chances with strong follow-through, reducing overall efficiency. How experienced traders handle choppy markets: trade less or sit out entirely, reduce position size, switch to range strategies, buy support, sell resistance, wait for confirmed breakout with volume expansion, use wider stops with smaller size, focus only on high probability setups. A useful rule many day traders follow: if the first 60 to 90 minutes show overlapping candles, weak volume, and repeated reversals, it's often better to protect capital and wait for another day. Several indicators are specifically useful for identifying choppy, range-bound conditions. The goal is not to generate trades, but to warn you to stand aside. 1. Average Directional Index, ADX. This is one of the most direct chop detectors. ADX measures trend strength, not direction. Below 20, weak trend, likely choppy. 20 to 25, transition zone. Above 25, trend forming. When ADX stays low and flat, it signals lack of directional conviction. Many traders avoid breakout strategies entirely in this environment. 2. Bollinger Bands, band squeeze. When the bands contract tightly, volatility is low, price is compressing, breakouts are more likely to fail initially. A tight squeeze often means chop until expansion occurs. Traders wait for bands to widen before trading momentum. 3. Choppiness Index. This indicator is specifically designed to measure whether the market is trending or ranging. Above 60, very choppy. 38 to 60, neutral. Below 38, trending. High readings suggest avoiding trend-following trades. 4. Average True Range, ATR. Low and declining ATR means small price movement, limited follow-through, increased whipsaw risk. When ATR compresses, risk to reward shrinks, which is common in chop. 5. Moving average convergence divergence flattening. When the MACD lines stay near zero, cross repeatedly, show small histogram bars, it often indicates sideways conditions. 6. Moving average flattening. When multiple moving averages, like 9, 20, 50, flatten out, intertwine, price crosses repeatedly, this is a visual sign of chop. Most reliable combination. Many traders use ADX below 20, Bollinger Bands tight, ATR declining. When all three align, probability of choppy price action is high. Simple practical rule: if you see low ADX, tight bands, flat moving averages, you're likely in a don't trade environment. This filter alone can eliminate a large portion of low quality trades.